It's time for an MFA Wealth Market Update. Welcome. I'm Chris McBann, the president of MFA Wealth. I'm joined with Greg Dukes, executive vice president. I'm also joined by chief equity strategist Will McMahon. Gentlemen, let's talk about the year that's already here. It's already the middle of February as we're looking at things. Greg, what do you think so far?
Very exciting first 6 weeks of the year. We'll talk about this a little bit more, but again, interesting parts, not only from the Dow, S&P. S&P is up around 1.7% year to date. The interesting part has been the emerging markets. Emerging markets are up around 7.3, and the developed markets are up around 5.7, largely due to the fact that the dollar has weakened around 1.1% since the beginning of the year. That leads to another continuation of what's going on in the developed markets overseas for us, and in a strong start to the year.
Well, I know it's been driven last year. We talked like this. We were very pleased with our portfolio returns. We were very pleased about the Magnificent Seven, the Magnificent Six, depending how you do the math. But as we see this, we were talking about it broadening out. What is your global sense of the markets and where are we modifying our thoughts going forward?
Yeah, absolutely. I think to Greg's point, the broadening out is happening across the board. International, the continuation of last year, and really to start this year here in the U.S. If I look at my screen today, the Russell year to date outperforming the S&P almost by 2x. Fascinating to see when we think about sectors. Chris, you mentioned the Mag 7, Mag 6. The Mag 7 index, equal weighted, down 6% to start the year. If we think about that, fascinating. Such a reversal from the last 36.
On 6%, Will.
Down 6% versus essentially a flat S&P. When I look at sectors for the year, a month and a half on, and the energy sector of the S&P up 21%, materials 17%, tech down 2%, financials down 4.5%.
Well, to your point, though, this is exactly the broadening you're talking about. Where are these data centers being built? How are they being powered? That's real estate. That's energy. That's materials. These are all the things that we were talking about.
How much of this is powered by lower interest rates? How much of this is just turning on because interest rates are coming down?
That's a very good point. That the new Fed chair is going to be an important continuation of that conversation.
Sure.
And what we are kind of seeing is expecting 2 rate cuts between now and June. How that impacts inflation, how that impacts unemployment. These are things that we're watching very closely.
Well, I know we've been talking a lot about the Fed was talking about 2% inflation, which I always thought was aspirational, but very difficult to get to. It looks to me like all the measures across the board are at 3% now, which seems like a very good number. How do you interpret that?
Absolutely. We are hopefully entering a period of Goldilocks, growth with moderate inflation. And really the only way you get that is efficiency gains, more productivity in the market. How much that can be driven by AI is still yet to be seen, but more efficiency at the corporate level is exactly what's going to drive solid GDP growth without inflation. I think new Fed Chair Kevin Warsh will be absolutely focused on that. I think one other thing we should touch on, guys, is really a continuation of all the things we're talking about. It seems right now that the market is telling us they want physical. The market is shifting back, and so for so long it has been data, technology. The non-physical. Right now, if I look at these screens, everyone wants what can I actually have atoms in the ground, materials, energy, the things that actually drive the real economy.
Wait a minute, you're saying real stuff. You're talking about real stuff. Something we touch.
Stuff.
Correct.
Exactly. Absolutely. It's really been a fascinating start to the year.
As we see it, I mean, I know we look, I think Deutsche Bank, JP Morgan, they were calling for 12, 13% growth in the S&P this year. I think we even call for 11%-ish in the Dow. Here we are in the middle of February. We're up, I think 4-ish, 4.5 right now. Any modification to that number? You guys want to stick with that number? How do you feel about it?
No, I think that's good. The second half of this year is going to be interesting.
Yeah.
As these numbers continue to evolve. The first half, everybody on an economic front, Chris, continues to report very strong earnings.
Yes.
Very strong outlooks. Nothing real dovish that to speak of on the good side. Nothing real hawkish on the downside.
So we're spreading out our portfolios. We're broadening out. We're buying things that are tangible, although not completely getting rid of the certainly by no means capped, right?
Correct.
Memory's still a big thing. Well, I think we're adding some actual minerals. Copper, we're talking a lot about. Can you talk about that for a minute?
Yeah, absolutely. For what's really happened for so long, is the focus on the bottleneck trades. Where are bottlenecks existing that go into all of the things to build AI? One of the latest ones we're focused on is copper. The electrification of the data centers also has a lot of applications in the EV market. So we would definitely want to get that onto our portfolios start the year.
So the electricity has to go through something to get to where it's going, and that's copper.
Absolutely.
Wow, think about that for a second. So I think in general, if I think we're remain cautiously optimistic. We're excited about a couple interest rate cuts. We are reacting to a broadening out of the market, right? And we like physical, tangible assets more than we have in the past. We also like international, like you mentioned.
Right.
Lower interest rates will help these small mid cap companies, and also I think we'll start to see a pickup certainly in the companies going public. I mean, I think it's likely more airlines are going public. We may have a record year, companies going public. So I don't think we're but remember, at some point, we talk about this all the time, the music will stop. It's not a matter of when, if, it's a matter of when. We do have stops on most of our portfolios, which is an important strategy. But beyond having stops and diversification, I think our clients are generally very well positioned.
Very much so. And why it's critically important, as we talk about all the time, to stick to your risk tolerance, make sure you're appropriate at the asset,
Absolutely.
and make sure that, there's going to be good times, there's going to be bad times. That's why we need to know how much risk we can handle.
One last thing. Well, when people are talking to us about crypto, we always say it's a highly speculative play. The prices come down for them significantly. People said, well, look, we don't trust crypto. We want gold. So that's why gold prices are through the roof, and we benefited from that here. Is crypto, something they should think about for only the speculative part of their portfolio? What are your thoughts, Will?
I think we've had somewhere between a 1 to 2% allocation in crypto for most of our base portfolios for last year. Given the volatility we've seen in the asset class to start the year, it is something we want to explore, maybe to take a nibble on. It's essentially leverage tech. That people want to talk about it being a decoupling of the U.S. dollar. We haven't really seen that necessarily play out as much. It seems to really track the tech indices and be a leverage bet on that. But it is, it has been highly appreciative in the past. So, good, prudent asset management would tell us we want to buy some at these levels.
Great summary. Great being with you both. Thank you all for our clients. We're here at mfawealth.com whenever you need us. Thank you.